of 2021. So specifically, they actually put up a surprise profit. They also beat revenue by about 15%. Analysts on the street very positive, thinking that this is going to be a bit of a turnaround for the company, that this online betting and fantasy sports betting company, that they have moved in the positive direction, positive EBITDA for the first time, and that the gambling, the momentum should continue, and especially ahead of the key NFL season. This stock, John, on the year into today, up 163%, sort of one of these stealth rallies in a name that had been beaten down last year, but right now, again, absolutely surging, up 15% on these strong results.
Hardly talked about it. What a move on the year and on the session, so far at least. Abby, thank you. Different story for Block, very different story. The company's gross profit growth forecast falling short for investors. The co-founder, Jack Dorsey, saying this: leaders across our company are now looking at the true full cost of their businesses, leading us to pull back on our pace of hiring and to focus more on performance management. Katie has more. Hey, Katie.
Hey, John. Well, it's rough out there. Block shares currently down over 9%, even though on several measures this was a beat and a raise quarter. If you go into the numbers, gross profit soared 27% to $1.87 billion. That's above the average estimate of about $1.8 billion as both the Cash App and the Square businesses delivered. Block also boosted its full-year adjusted profit to $1.5 billion. That projection is up from $1.36 billion, and that's all good news, but it's that guide that you mentioned that's showing up in the shares today. The guide for July's gross profit growth came in at 21% year over year. That's actually slightly above Wall Street's consensus, but as Jefferies analyst Trevor Williams phrased it, that figure likely below buy-side expectations, and you can see that in the stock this morning, now down 10% as trading gets underway, higher by just 6 or 7% on the year, John.
Brutal stuff. Thanks for that, Katie. That stock getting hit hard around the opening bell about 3 minutes into the session. I want to turn to tech. The two big names, Amazon giving a positive sales outlook while Apple faces a big sales slowdown. The CEO, Tim Cook, saying, quote, "We continue to manage deliberately and innovate relentlessly, and we're driven by the sense of possibility those efforts inspire." Ed Ludlow, almost poetic from Tim Cook there.
Yeah, almost poetic, but it doesn't hide the fact that Apple is not immune to the macro environment, John. What we got was a story where the smartphone market in the US is not strong. There were bright spots, and the numbers are mixed going into the rest of the year. So ultimately, Apple beat on fiscal third quarter revenue, the quarter ending in June, coming in overall at $81.8 billion, slightly ahead of expectations. But in the fiscal third quarter just gone, iPhone revenue was softer than expected. What it means, all told, is that this is the third consecutive quarter where Apple has experienced year-on-year declines, going back to 2016 for 3 consecutive quarters. The commentary from Luca Maestri, the CFO, is that going into the fiscal fourth quarter, ending in September, they expect iPhone and services to accelerate, but other business lines like iPad and Mac to decline double digits going into that fiscal fourth quarter. The question is if Apple sees an overall sales decline year on year in the next quarter or the current period, 4 consecutive quarters of year-on-year declines, you have to go back 20 years for that level of sales decline in this company. So there's a lot happening here. Bright spots included Greater China, which overall has returned to growth. India had a record month in the month of June, and the opening of retail stores there has had a quicker than expected impact. Services revenue overall passing $21 billion for the first time, but the narrative from the street is that services has had momentum anyway. Complete contradiction with Amazon, up 9%, going towards 10%. That puts it on an intraday basis for its biggest jump since November. Amazon, the story, a beat across the park. Overall top line growth 12%, 4% on the .com business, but they're getting better at making money on the more profitable elements of Amazon.com, namely advertising and selling services to independent merchants. Then you look at AWS, the cash cow, the bright spot. It continued to grow. And even though we'd had that guidance from the prior quarter that going into April, AWS growth had decelerated 500 basis points, what ended up happening in the quarter was it stabilized. And they stopped short of saying there's a rebound in cloud. but they talked about customers putting an end to their cost optimization. In other words, customers stopped playing it so safe. So a really strong beat, but the story is Andy Jassy having real cost discipline, and that's showing up now on the bottom line as well.
Two different stories, two very different stories. Amazon up by 9% right now, Apple down by 2.7. Ed, we'll talk more about this, but the South Side captured this almost perfectly. You just go through some of the revised calls this morning, looking at, say, Amazon, price targets hiked, Morgan Stanley, Piper Sandler, Citi, Evercore taking their price target from 150 to 190. We're only at 140 right now. Apple, can I just lean on this one, this quote that came from KeyBank, Ed, and get your thoughts on this? Analyst worries that the US upgrade cycle is coming to a halt. The upgrade rates are at all-time lows and likely to result in weak revenue in the United States. Now, Ed, what do you think that means going into a new product launch in the next month for this quarter?
Well, those are exactly the two factors that were addressed. In the quarter just gone, there was no substantive product launch, which didn't drive an upgrade cycle in any of the product categories. What we're waiting on is the iPhone 15. The expectation, according to Mark Gurman's reporting, is it comes in this quarter. The bigger picture commentary when asked about the macro environment is Tim Cook said we have an uneven macro situation, but the smartphone market in particular is weak in the United States. That is partly an inflation and consumer issue, and it is partly an upgrade cycle issue. And as you know, during earnings, Apple does not talk about products that are not yet released, but that is what the expectation is. And again, I go back to it, John, but for me, you always get the key detail, not necessarily from Tim Cook, but Luca Maestri, the CFO, and he gives very small but specific guidance that going into the fiscal fourth, iPhone accelerates again, and a big part of that we think is going to be the release of the iPhone 15.
Interesting. Ed, stay close. We'll come back to you on that. The broader market right now, a lift here, a pickup about 7 or 8 minutes into the session, up by 0.6% on the S&P, on the Nasdaq up by 1 full percentage point. Turning back to today's jobs report, Mohammed Al-Aaron on this program a little bit earlier. Take a listen.
It's a job report that has something for everybody. If you're in the softer landing camp, you will take comfort from a payroll gain of 187,000 below the 200,000 forecast and lower hourly worked. If you're in the harder landing, you will worry about the 4.4% wage increase driven by 0.4 month on month, and you'll also worry about the low unemployment rate.
Joining us now to discuss two of the very best, iCapital's Anastasia Amoroso, PGIM's Mike Collins. Anastasia, you've said it before, this Fed might be on hold, it might be almost done. Do you think this data this morning backs that up?
I think it does. I think this is an in-line payrolls report, in line with market consensus, but also in line with Fed wishes. I mean, if you zoom out, if you look at the labor market data, we continue to trend down in terms of job creation, and yet we continue to see the unemployment rate that is still holding on around 3.5%. So that's really the best case scenario for the Fed, is gradual rebalancing of the labor market. By the way, job openings continue to come down as well. Labor participation rate continues to go up and is above pre-pandemic levels for prime age workers. So I think that's all that the Fed really wants to see. And of course, yes, there's a 4.4% wage growth number, but look, 4.2, 4.4, I think they're close enough. So I think the Fed is going to take that in addition to the inflation data that is showing a disinflationary trend, and we'll say this is in line with what we want to see, and therefore we may have to pause here.
Mike Collins, would you agree with that assessment?
Yeah, it feels like the soft landing camp is definitely winning out here, Jonathan. In fact, after today's move lower in rates across the intermediate part of the curve, the markets have effectively taken out the probability of any more Fed rate hikes. So our view is the Fed is done. The funds rate is restrictive enough. It's going to continue to get more restrictive as inflation falls, that passive tightening everybody's talking about as the real rate continues to go higher. But what's priced in for next year is still 100 basis points of rate cuts. So that's really the big question.
So Mike, with that in mind, and I know you and the team have been thinking about this, within fixed income, am I playing for income, capital returns, total returns? What am I doing?
Yeah, as you know, we've really been short duration, Jonathan, in our strategy. That is kind of betting that the 5 and 10-year yields were too low relative to the funds rate, right? When the 10-year was at 3.5 a couple of months ago, and the funds rate is pushing against 5.5, that's too big of a gap. And as that rolls up the curve, you actually get paid to be short. But now we've had a huge move. The markets feel like they're more fairly price with the 10-year, at 4 1/8 today, the 20-year pushing against 4 1/2 the other day. That feels fair value to cheap to us. So we're covering that in and certainly advising our clients to add duration here. You are clipping a coupon. You're clipping a bigger coupon every day. It's a great yield the bond market is offering you. And you do now finally have the potential for some upside in price if you kind of continue to get a moderation in growth.
Anastasia, that's the fixed income side of things. On the equity side, I've said it a few times already this year. It's worth saying again. You've had a great year on the equity market, much more constructive than most coming into the year, and you remained constructive. Now you're looking for that broadening out. Are there reasons to believe that can continue after it started around June this year?
Yes, for sure. I think the biggest reason is economic growth. I mean, if you look at, for example, the Atlanta Fed GDP now number they came out, the nowcast for the third quarter is running at 3.9% GDP growth. I mean, that is better than the first 2 quarters. That is an acceleration versus the deceleration that the consensus was expecting. So, to the extent that that holds, that certainly bodes well for companies. It bodes well for the earnings upgrade cycle, and it should bode well for the stocks. So, we've obviously seen, and speaking of, what kind of stocks benefit the most, I mean, if you look at the performance this week, financials, for example, didn't sell off nearly as much as technology and some of the other sectors. And part of that reason is we've seen this, re-steepening of the yield curve, which of course is positive for financials, but so is a soft landing. And so is, the lack of major defaults. And so is, the potential for yields to maybe go down from these levels. So I would say, Jonathan, for sure there's a broadening out that is justified. And I like that it's actually being led partially by financials.
Mike, Anastasia mentioned the move in the bond market. I want to finish there with you, Mike. That lift in yields, that steepening in the curve, gone back and forth with a range of guests on this through the week. Just what was the dominant factor behind that move, Mike? And the reason I think we've got to diagnose it is you've got to work out whether it is sustainable, it continues, and whether the factor behind it this week is something we have to live with through the rest of this year. Was it the data, Mike? Was it the supply? Was it the downgrade? A lot of people say it wasn't the downgrade. Is it the BOJ? What is it, Mike?
Yeah, I don't believe it's the credit downgrade of the U.S. Treasuries and agency mortgage-backed securities. I think it's a lot of things. The data continues to be resilient, but the positioning was offsides, right? I think the market, investors generally had gotten really long duration. I mean, it seems like the consensus had shifted to really long. We were taking the other side of that. So I think that positioning alongside pretty resilient data and a Fed that really seems like they are going to be stalwart, that they're going to hold that funds rate at a higher level for longer. That's what happened in the curve this week.
The yields this morning speak to that too at the front end. In fact, through most of this week, the front end's not done much at all. We're down by 7 basis points this morning on a 2-year at about 481. Anastasia, Mike, love doing this with you as well. Post payrolls to get an update from you both on fixed income and equity alike. About 14 minutes into the session, your equity market on the S&P 500 just about positive here by 0.5%. Coming up, Amazon impresses, Apple disappoints.
The results reflect the fact that the environment is challenging. Consumers face pressure from general interest rates, higher inflation, and so there are a lot of cross currents that Apple, like all other companies, cannot outrun.
We'll head back to the West Coast and catch up with Ed Ludlow. Plus, up next, CFRA's Angelo Zeno.
Amazon collectively needs something like $3.4 billion for an incremental basis point or percentage point of revenue growth. They're going to need advertising. They're going to need video. They're going to need healthcare. They're going to need something else to come in to take the baton from AWS over the long term.
Tom Forte, D.A. Davidson weighing in on Amazon, the company delivering better than expected results, reporting a spike in sales for its cloud computing arm, AWS. Different story for Apple, AWS rather. Different story for Apple, of course, dropping below its historic $3 trillion market valuation as it faces its longest sales slump in decades. Ed, back with us for a little bit more. Hey, Ed.
Yeah, it's the guide from Apple is that going into the fiscal fourth quarter, it will be much of the same. If they maintain that growth rate and we do get a fourth consecutive quarter of year-on-year declines, it's the longest streak of sales declines for Apple going back 20 years or more. The big point is there is an admission from executives that there is a slowdown in the smartphone market here in the US. Bright spots in India and China were interesting. Also, we haven't talked about the impact of foreign currency, and there was a real emphasis from both Cook and Luca Maestri, the CFO, that on a constant currency basis, sales would have grown. But it just reminds us, John, Apple is a truly global business. And if you have the bright spots in markets like India and China and elsewhere, then you have to factor in the FX headwinds. And actually, sequentially going into the fiscal fourth, they did guide that that would be on an ongoing basis a headwind.
Ed, thank you, mate, for the update. CFRA's Angelo Zeno maintains a buy rating on this stock, 220 price target. I'm pleased to say that Angelo joins us right now. Angelo, let's go through this together, and thanks for being with us, by the way. Reasons to be constructive. Can you go through them for us this morning?
Yeah, listen, I think the biggest reason to be constructive, or kind of the biggest positive takeaway from this earnings call was the services side of things, and I think most bulls would point to that. You saw 8% growth on the services side. The expectation, at least on our end, was for about 6% growth. And, it's actually finally an acceleration from what you've seen the last 3 quarters where services growth has decelerated. And actually, Apple actually indicated that you're going to see further acceleration as you go into that September quarter. So that's a change of pace to what you're seeing on the hardware side of things, and essentially all across the hardware side, specifically on the iPhones, where we saw a 2% decline on a year-over-year basis. And, I do think that really indicates the health of Apple in some respect, where you're seeing positive and accelerating services growth amid a decline on the iPhone side of things. Almost kind of tells you that they continue to do see switcher rates continue to improve and that installed base continue to grow, and that's really helping the services side of things. So I think longer term, the health of Apple remains very good. But as far as kind of what they're having to navigate through right now in terms of some of the challenges on the hardware side of things, that's something that they've been doing here for the last couple of quarters, and they're going to need to continue to contend with, at least in the near term.
Can we build on that just in the near term, Angelo? Upgrade rates. This has been the bullish thesis for a while. You've got this big base that need to upgrade. They're going to come and buy a new phone. What's happening with upgrade rates, and how do you think that's going to change in this quarter when we get a new product launch?
Yeah, I mean, listen, I think you did have a slight acceleration in terms of the upgrade rates when you had the 5G launch. Actually, what you're looking at here in terms of the iPhone 14 cycle is replacement cycles have extended after kind of 2 very good years in terms of the 12 and the 13. But the 14 has actually held up very well because average selling prices have actually largely offset a lot of the unit declines. And that's largely due to the fact that consumers are willing to pay more for those higher priced devices given the change in strategy Apple has made with this cycle in terms of essentially putting all the key upgrades on kind of the pro devices. Now, as we kind of look forward, in terms of the 15, we're not looking for much in terms of an acceleration in terms of those replacement cycles. But that said, the comparisons get super easy as you kind of start going into the December quarter. Most people will recall some of the COVID-related headwinds a year ago, so they start lapping that. There's actually been some challenges in the U.S. market in terms of iPhones in the last 2 to 3 quarters. They'll start lapping that as well. So I think you start seeing some easier comparisons where they should be able to see a return to growth in the iPhone 15 cycle, but nothing kind of major that we anticipate until a foldable launch finally comes to fruition.
Can we just drill down on ASP just quickly? The average selling price of a phone. Angelo, there was a hope this year that if unit sales growth was stable, that they'd be able to do something with the average selling price of the phones they sell. Based on what we've learned in this quarter, do you think they can?
In terms of what? Increasing selling prices?
Putting prices up, yeah.
Yeah, I mean, listen, I think there's the potential that they can do that on the pro side of things, and it might be something that they look to do on the next cycle. But to be honest with you, given some of the challenges that we're seeing kind of specifically in the U.S. market, I'd kind of be hard-pressed to really see them really increase prices on my end of things. I mean, we'll kind of see what happens here, with the iPhone 15 cycle, but I'm not necessarily kind of embedding that within our forecast.
Angelo, thank you, sir, for the update. Angelo Zeno there, constructive on the longer-term opportunities, near-term challenges could linger. For the stock, we're down by close to 3% at the moment. About 23 minutes into the session, positive here by 0.4% on the S&P. Up next, your trading diary. Trying to snap back from a three-day losing streak on the S&P, up by a third of 1% here. That's the price action. Let's get to the trading diary. Fed speak picking up Monday, Bostic and Bowman. Earnings picking up Tuesday with UPS, Rivian and more. Then Disney reports on Wednesday. Thursday, we'll get US CPI, plus another round of jobless claims. We'll round out the week on Friday with PPI and UMich consumer sentiment, and certainly hoping for a quieter week in the bond market than the week we got this week. Looking ahead to CPI, that's your big print next week. From me, that does it for me, and thank you for choosing Bloomberg TV. Have a wonderful weekend if you can. This was the countdown to the open. This is Bloomberg.
from the financial centers of the world. This is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day on Friday, August 4th. Here are the top market stories we are following for you at this hour. Payrolls puzzle. July jobs come in light at 187,000, the lowest since December 2020. But with the unemployment rate down to 3.5% and wages coming in hot, what's going on in this labor market? And what will the Fed think? We'll get insight into how the data impacts the monetary policy path as Chicago Fed President Austin Goolsbee joins us live for an exclusive interview from Aspen. And bite out of Apple. The company's market value is set to drop below $3 trillion with concerns over its sales outlook. Amazon, though, soars as its revenue grows and spending slows. From Washington, I'm Kaylee Lyons with Guy Johnson in London. Alex Steele is on assignment. Welcome to Bloomberg Markets. Guy, happy Friday and happy Jobs Day to you.
I'm not sure I'm that happy about what has happened here today because I'm really struggling to understand the market reaction, what the data actually tells us. Does it change anything? I think, so Kaylee, you've got to take a step back. This week has been about a massive move in the bond market. Why are we seeing a bid coming back into the bond market today? Is it because of the payroll number, or is it simply because everybody's been selling all week? And that, I think, is really critical. And then you look at the wage data you highlighted in the headlines. Does that wage data tell us that the Fed's going to struggle to get down to 2% anytime soon? And if so, shouldn't the bond market be on offer on that, yet it's bid? So I think the context and the positioning coming into the number really matters. I'm not sure our understanding has taken any big leaps forward today in terms of the evolution of this economy and what is happening with the labor market.
Yeah, you make a really good point, Guy. 2 Fridays ago, the 10-year yield was at 383, I believe. So even though we have a 5 basis point, 6 basis point drop today, we're still at 411. We are still substantially above where we were just about 10 sessions ago. So it really does create quite a puzzle because the market at this point seems like it's clinging on to the fact that you saw a disappointment in payrolls today and those downward revisions for the 2 months prior rather than the wage figure. But I wonder if the wage figure is the one the Fed will choose to cling to.
Absolutely, and the Fed has talked about wages and also just fold in a positioning story. We've been selling all week. Is this just an opportunity to buy what maybe are slightly better levels? Anyway, the wage story I think is absolutely front and center. Kaylee came up with this one. I think it's a great question. Let me just bring it up onto the screen so everybody can see its beauty. If wages keep growing, will yields keep going? Which direction yields keep going in maybe is an open question. Bloomberg's Mike McKee, Ira Jersey, join us now. Ira, what do you think? In theory, a hot wage number would imply that the Fed is going to struggle to get inflation down to target anytime soon. Is that too simplistic? If wages keep going, should yields go higher?
Yeah, I think that is correct, and it's not so much that yields go higher because the Fed's going to tighten a lot more. It's more that we could start pricing out even more of the cuts that are priced in for the second half of 2024. So let's say that the Federal Reserve was going to stay on hold until the end of 2024 and maybe into 2025. That means that a lot of instruments, 2-year yields, 5-year yields in particular, would probably have to sell off a little bit from here, and we see an inversion of that yield curve at least a little bit. Now, that doesn't mean the long end would have to move very much, so you could still have 10-year yields 4% plus or minus 25 basis points, which is probably where we're going to end up for a little while. But it's that front end of the curve that you can wind up seeing some of that uninversion just because of the lack of Fed market reaction to going forward.
Yeah, well, you definitely are seeing greater movement at the front end today. The 2-year yield down 9 basis points. We're back down at 479. And Mike, just to think about what it means for the Fed, if we continue to see a deterioration on the payrolls figure, but wage growth stays hot, that's what they'll fixate on, right? Even if we start to see quote unquote cracks in the labor market, theoretically, if what people are getting paid is climbing, that's inflationary and they're trying to fight it, right?
Well, there's a theory that it's not inflationary, that wages follow inflation rather than lead inflation. And I think the Fed will look at this and say that it didn't go up again. It stayed where it was. And if we continue to see the labor market weaken, then we are likely to see the wage levels start to go down. Also, if you look at the composition of the raises that people got, a lot of it was in construction, a big jump in construction because there are shortages of workers there. But new home builders are having to lower prices on their homes in order to get people to buy them because mortgage rates are high. So at this point, there's kind of a trade-off there. And then you could also see more people in the goods sector this month, but that's been back and forth between services. Services was the area of shortages. And so the Fed also has another jobs report before their next meeting, so they'll probably look past today and wait and see what happens.
They'll definitely do that. They'll certainly wait for more data. But if you fold in the wage number into the union story as well, isn't there an argument to be made that this wage story is becoming stickier? And that is just going to make it that much harder for the Fed to get inflation down to 2%. Is today's wage number, consistent with 2% inflation?
No, it's not. And I don't know if the control room can get this up, but we have a chart that shows basically what we're looking at here is the year-over-year number at 4.4% is running above the level that the Fed thinks is sustainable for 2% inflation, which is 3 to 3.5%. So that's what you have to close. That gap is what you have to close before you're going to get the Fed to think that that things are going okay. That blue line has to go down into that green area. And so that's what the Fed's going to be watching for. The question with the labor pattern agreements is, does that spur a lot of additional spending in areas that will then see shortages because there's not enough supply to meet demand, and then that pushes inflation up. It is something for the Fed to watch and be concerned about, but it's also something that it's going to be hard for them to do something about.
Well, and Ira, as we talk about what the Fed wants to do something about, we know that they want to stay on that path to a soft landing. It seems like the narrative is building that the landing will indeed be soft. The Fed's own staff is saying that a recession isn't going to happen this year, changing its view. But I just wonder if the inflation fight can be won if the landing is soft. Is the data signaling that you can't have both at the same time?
Well, it winds up being relative, right? So if inflation, let's say CPI is running at, 0.2 some months, 0.3 other months, then, that suggests that over time that you'll see that year-on-year inflation number continue to come down. Interestingly, and I just, we need to talk about, I think, the move in rates that we're, not only what we're seeing today, but indeed the last 2 weeks, is that it's almost all come from real yields, right? So the market's not concerned about inflation reaccelerating. When you look at what's happened to inflation break-even, inflation swaps, as well as the TIPS market, all of the move has come in real yields. And that suggests to me two things. One, a reassessment of what the Federal Reserve is going to be doing in terms of monetary policy. And two, the supply dynamics and what's going on with the deficit and how sticky the deficit's going to be over the medium term, so that supply needs to come in. So watch that real yield story, because I think that's going to give more of an indication of what the market's really worried about versus the Fed. And the Fed's worried about inflation not coming down quickly, but at the same time, the market's more concerned about the Fed not cutting quickly.
All right, just talk to me about the supply story as well, because I'm fascinated by this. There is clearly a view now that there is going to be significantly more supply, and we are now questioning who the buyers of that additional supply will be. If we do see longer duration rates going higher, how does that impact what the Fed does? Does it have any impact? A lot of companies finance kind of 7-10 in terms of the duration that they work with. If we see that additional supply pushing longer term rates up, how does that feed back into the economy? What effect does it have, and how does that then influence Fed policy?
Yeah, so the Fed's going to worry about it insofar as how does higher yields in that 10-year sector, say where companies finance, how does that affect investment and the like? I think as long as the economy is as strong as it is, the Fed's going to look past that and not worry so much about it. If the economy flags and the economy gets really weak and we need more investment and incentivized investment, then the Federal Reserve cutting interest rates and then maybe doing another bond buying program, which I don't think is going to happen. All this talk about yield curve control is a joke, quite frankly, because that would be counterproductive to what the Fed's trying to do.
All right, Ira Jersey of Bloomberg Intelligence and Bloomberg's Michael McKee. Got to leave it there, but thank you both so much for joining us. And coming up, we're going to have more on the jobs data and what it means for the Fed with Austin Goolsbee, the president of the Chicago Fed. That's coming up. This is Bloomberg.
From Aspen, Colorado, for our Bloomberg television and radio audiences worldwide, I'm David Weston. I'm delighted to be joined right now by the president of the Chicago Fed. He is Austin Goolsbee. Austin, thanks for being here.
You bet.
So we're out here for the Aspen Economic Strategy Group meetings. A lot of talk about fiscal issues, monetary issues, but we all have now the key jobs figures. A little bit lighter than expected, 187,000 instead of 200,000. A little heavier than expected on the wages. What did you take on?
It was pretty much what we expected. I mean, let's remember, the jobs number is whatever it is, plus or minus 120,000 a month. So there's no point quibbling over numbers. The job market is cooling a little to kind of a balanced level, but it's still extremely strong. That's the strongest part of the economy by far, is how low the unemployment rate is, and people can get a job if they want a job.
And to that point of being tight, 187,000 plus or minus is still way more than you need just to catch up, to keep even with the new people coming into the workforce. So it is tightening in that sense, is it not?
I think that's right. You know, let's say 100,000 just from population and what's coming into the workforce. So it's stronger than that. It's been the surprise of the year, of the 6 months, that all of the people that folks thought were gone from the labor force never to return, a lot of them are coming back. You know, when the job market is as strong as that, you've seen labor force participation rise back to levels that we hadn't seen for several years at least. So that's been great. I mean, that's the strongest part of the economy.
Yeah, none of us wants anybody to be out of a job, so it's a good thing. It's done this many people out of jobs. But what about the wages? We're now, these numbers were 4.4% year over year, I believe it was. That doesn't sound like something consistent with getting to 2% inflation overall.
The way I view it is two things. One, you can't say anything about wages until you actually know what's happening with productivity. We got some productivity numbers. They were strong for the quarter. That's very noisy, but if you have strong productivity growth, you can have wage growth and it doesn't generate inflation. And the other thing about wages is they're not a leading indicator of price inflation. They're backward looking. Wages move more slowly. When things happen, we get shocks. The prices move first and then the wages. So when we see what's happening to wages today, this is kind of an amalgam of a bunch of stuff that already occurred. I think if you want to know if you're beating inflation, go watch the inflation. You know, the price series and especially the new months of inflation in the core. That's really what you want to be watching.
What are those numbers telling you right now, particularly goods inflation? Is it a bit stickier than you thought?
It has been, but the last couple of readings have been pretty positive. It's important that you raise this goods. Loosely, if you look at core inflation, you got goods, you got housing, you got services, not including housing. And we've much remarked on the stickiness and persistence of services inflation. But we knew that's not where we went wrong over at the end of last year, beginning of this year, with inflation lasting a little longer than we thought. It has been that goods prices, while down, have not gone all the way down to where they were before the pandemic. I feel like that's kind of started, and that's put the Fed on this line. I mean, it's a thin line to walk, but getting the prices down without having a big recession, we're going to Johnny Cash this thing and walk that line, and that's for sure the goal. And goods prices got to come down, and then the next one's got to be housing. As you know, it's the housing that's in the CPI is based on a bunch of market rents, and it takes a while to flow through. So hopefully as we go into the fall, that's going to be the next one.
So also let's stick with the Johnny Cash.
Yeah.
Walking that line.
Yeah.
Okay. How long is the line? And we know that the target is 2%.
Yeah,
it doesn't
right.
feel like you're going to come off that 2% goal. But how long till you get there? How patient can you be?
We got to be somewhat patient. You know, take as just a microcosm example this thing with housing. We've seen the market rents coming down, but it takes a while for that to flow through into the, let's call it the average housing prices that are in the CPI, and you just got to be patient. I know everybody wants to say, fine, Bob, we're done. That's not how it works. If you walk the golden path and you walk that line, it's going to take a while. And rather than arguing about the peak rate of how many more rate increases do there need to be, what we should probably start thinking about is that, well, how long does this last that you're going to be at these elevated rates? It's been a 500 plus basis point increase over a relatively short period. If you hold at 5.25, 5.5, 5 and whatever, while inflation goes down, that is a restrictive environment. Yeah. Holding is increasing restrictiveness in that sense.
Austin, let me ask you one other question that came up this week, which is the Fitch rating on the U.S. sovereign debt that took back. Surprised a lot of people, I think. Is it important? And I'm not saying was the rating important in of itself, but is what they're pointing toward important?
In a vague sense, yes, but everybody knows that. I mean, we went through the debt ceiling. Every day we're talking about this is dysfunctional. We've got to get out of this dynamic. I was around in Washington the last time we went through this downgrade thing. There's a couple of things I don't understand about it. Ultimately, I don't think it's going to make that much difference. This isn't like some obscure stock or bond that nobody knows, and it's, the rating agency went and looked at it, so you don't have to. I mean, U.S. Treasury is the most observed market with the most information in the entire world. So I don't know what their motivation was. I'm not gonna guess at that, but I guess I don't see how something else is going to be rated AAA if they were defaulting on U.S. Treasuries, it seems like that would be a bad day for the market.
But also, let me ask you a different question. We've heard various Fed presidents, Jay Powell, but also Janet Yellen, talk about the fiscal sustainability of the path the United States is on, and expressing some concern over the long term that it's not sustainable. If that's right, what are the consequences of that, and what, if anything, can be done about it?
That's a whole separate topic from the, what should the ratings of treasuries be for right now.
But Fitch invoked that, right, in their announcement.
But then the proper question is, did something happen in the last 2 weeks that made you think that was different? As you know, the Fed doesn't weigh in on fiscal policy. Congress and the administrations, they have to sort that out. My read of the evidence is exactly what you say, that the long run, there's a fiscal gap in the United States. That long run gap, smaller in the United States than in most of the advanced, if not all of the advanced economies of the world, because our demographics are better. It's rooted in the aging of the population and Social Security and Medicare and things like that. And the U.S. has got some choices that it has to make, but gets to make in a way that some other countries don't get to make them. They already have income tax rates higher than our rates. They already have 25% VATs. They have worse demographics. Their spending levels are already higher to start with. Those fiscal questions will be with us for decades because the baby boomers are going to all retire, I think, over the next couple of decades. That's different from what we're trying to do at the Fed. Our job is we accept the economy as it is, we go watch the data, and we maximize employment and stabilize prices. That's what we're going to do.
One other development this week, a lot of people took note of, is Bank of America changed their call on recession. They had been predicting a recession in the fourth quarter this year or the first of next. And that sort of trails what we heard actually from the Fed chair last week, that the Fed staff now has taken recession and off the table.
We're going to walk that line. Yeah. That's what I'm telling you. The golden path. That's what we got to stay on.
And is that where you are?
I don't know if it's just what I want or if that's where I am, but I feel like we've been getting promising numbers on inflation. The new months of inflation in core inflation, especially goods and especially housing over the next several months. That's what let's keep an eye on. That will tell us, are we on this golden path or not? If we are able to pull this off, that will be a triumph. There are many smart people, and you've talked to them on the air, who say it's impossible. The Fed has never been able to reduce inflation as much as we're reducing it, and we need to now, without generating a big increase in the unemployment rate and a big recession. And while that has historically been true, this was a weird business cycle. It can be a weird recovery, and I am hopeful that we can pull it off. And so far, we've been doing it. If you look back a year, the unemployment rate is not up, and inflation has come way down.
Well, in fact, it came down a little bit, I think, this month, if anything. It came down a tad, right, from what was expected. But I want to be absolutely clear on this. You think that we can get inflation under control with unemployment rate in the mid-threes?
I don't know if it's exactly the mid-threes. What my goal, and I think that we can pull off, and it's what we should try, is to stay on a path where you get inflation down and you don't have a major recession. And there are a lot of people who, if you have in your mind this stable relationship trade-off between unemployment and inflation, the golden path is impossible. But if you believe that, the data have just not been backing that up. We've gotten inflation down a fair amount without increasing the unemployment rate, and the job market does need to get into balance. We have been in spots where it's been out of balance so hot that it's not stable. But we're doing that. Over these past couple of months, you see the quit rate, you see the vacancy rate relative to how many unemployed there are, and you see the jobs numbers pulling more into balance.
Walk that line.
Walk
Johnny
that line.
There you
That's
go.
what it is.
Okay. Austin Goolsbee, thank you so much. He is the president, of course, of the Chicago Fed. Now back to you.
Thanks to Johnny Cash. Sorry, Austin Goolsbee. Thank you very much indeed, David Weston. Fantastic interview. Very much enjoyed that. Some analysis, some instant analysis, you could argue, on what is happening with the payroll number and the Fed's reaction to it. Fantastic to have that with David Weston. And there's some great coverage still to come out of the Aspen Economic Strategy Group. Very much looking forward to the conversations that are going to be happening throughout the day. Look at that. You've got Larry Summers. You've got all kinds of things coming up that we're going to be wanting to focus in on a little bit later. It is now 24, let's call it 24 minutes past 7 on the West Coast. That is what San Francisco looks like this morning. It's time we turned our attention to what is happening in the Bay Area and beyond. Silicon Valley very much starting its morning, and it has a lot to think about. Ed Ludlow. Let's talk about the compare and contrast between the reaction to Apple and Amazon.
Yeah, look, the story this season for earnings is investors rewarding companies whose legacy businesses do well and punishing those where there is not a strong or there is a worrying outlook. And that's been the story of Amazon and Apple. Amazon beat across the board. Its e-commerce business continues to grow at the top line. Overall growth 12%. AWS is still the cash cow. More worrying for Apple is that revenue did beat in the quarter, but it was still a year-on-year decline. 3 straight quarters of year-on-year declines for sales. You have to go back to 2016 for Apple to experience that kind of growth slowdown. And then the iPhone was weak in the quarter. We knew that would be the case because there was no new handset model this quarter. The iPhone 15 comes out at some point in the next 3 to 4 months. Services was a bright spot, but the big picture is that Apple is not immune to the macro picture. It suffers the woes of inflation just like everyone else. Amazon demonstrated that they've been able to get around that more nimbly. I think that's the compare and contrast.
Well, and Amazon, it's also about spending, right? Jassy's reining that in, and investors seem to like it.
Yeah, so I mean, capital expenses this year will be $50 billion, down from $59 billion last year. This is a company that got rid of 27,000 employees. But there's just a bigger picture story. Andy Jassy's been the CEO for almost 2 years now. He came in with Amazon having invested billions of dollars in a pandemic era where we were all at home and we wanted fulfillment for our packages to be there as quickly as possible. But they didn't need that scale now, so they've come out of it with discipline, but they are continuing to grow.
All right, Amazon up about 10%, Apple down about 3% at this point in the session. Thank you very much to Bloomberg's Ed Ludlow. And of course, you can catch Ed on Bloomberg Technology in around 90 minutes time. But first, more coming up here on Bloomberg Markets, so stick with us. This is Bloomberg.
Markets. Great questions.
We're about an hour into the U.S. trading session on this Jobs Friday. Bloomberg's Abigail Doolittle is tracking the move. So, Abigail, how are we digesting the data and the earnings out there?
Well, you know, Kaylee, overall, not too much of a reaction. A bit of a mixed reaction, but mainly to the upside at this moment. The S&P 500 up 0.3%. The Nasdaq up a little bit less. You can see that the SOX is down, but off of its lows, and the Russell 2000, which had been earlier lower, it's now up slightly. It's going to be interesting to see how this day, of course, plays out. But let's take a look at the two big stocks that you both were just talking about with Ed. We have Amazon absolutely soaring, up 9.7%. Its best day going back to November of 2022. So basically the best day of the year, while Apple down 3.2%, the worst day since January, and heading to its worst week since November of 2022. So a real split here. Amazon, of course, beat and raised. Apple, the concern around the slowing sales growth that we've been talking about in recent days. Investors really feeling it. Now, Apple reminds me to some degree of Microsoft. Now, Microsoft actually put up a roughly 8% sales growth, but it was considered to be a little bit light, especially since the composition of it with the cloud. Well, on that, Microsoft dipped below its 50-day moving average. Today, Microsoft is higher because relative to Apple, its 8% revenue growth looks a lot better than down 1.4%. But you can see Apple, we looked at the breakdown yesterday, it is breaking down more now, really firmly below that 50-day moving average, suggesting more selling may be ahead. As for some of the other big movers on the day, if we take a look at what is happening, Microsoft, again, looks a little bit better relative to Apple, up 1.4%. Booking Holdings up 8.9%. Great quarter there. Fortinet, take a look at this. The worst day ever going back to its trading history since 2009. Their guidance, the bookings and billings guidance, not great. The company's talking about macro uncertainty. It's unclear, given the fact that not so many other management teams are talking about that, why this cybersecurity company is seeing that, but clearly down. And then ResMed down 15.7%, the worst day since March of 2020. They have put up an earnings miss guide, weak margin. So a real divergence here between the haves and the have-nots on this Friday.
We're going to be talking about booking a little bit later on. Looking forward to that conversation. A little bit more on what is happening with this huge travel demand that we're seeing right now. Abigail, great stuff. Thank you very much indeed. Let's get back to the macro picture. A few moments ago, Chicago Fed President Austin Goolsbee joined this program from the Aspen Economic Strategy Group's annual meeting. Here was his reaction to the jobs data.
The job market is cooling a little to kind of a balanced level, but it's still extremely strong. That's the strongest part of the economy by far. When we see what's happening to wages today, this is kind of an amalgam of a bunch of stuff that already occurred. I think if you want to know if you're beating inflation, go watch the inflation. You know, the price series, and especially the new months of inflation in the core.
Yep. And we're going to get some more data on that front next week with the CPI print, so look forward to that. So does today really change anything? The bit that really stood out in so many ways from today was the hot wage number, and that takes us to our question of the day. If wages keep growing, will yields keep going? We've seen a big move higher in yields this week. Today, obviously, we're seeing a bid coming back into the bond market, particularly front-end yields coming off. But is that a trend we can rely on, or are all kinds of factors going to come together to produce higher yields? And if so, what does that mean for investors? Anna Rathburn, CBIZ Investment Advisory Services CIO, joining us now to try and answer that question. Anna, we've got higher wages. I appreciate it's a lagging indicator with the relationship to inflation, but nevertheless, the Fed's going to keep an eye on what is happening here. Do you expect higher yields from here, or do you think actually we've seen bond yields peaking?
I do expect to see higher yields. I think today is a reaction, perhaps an overreaction to some of the softness in the labor market, which we can get into. But to answer that question about wage growth, I think you have to look at it in conjunction with the productivity numbers. Now, if you look at the past 4 quarters of productivity, total productivity, it averages around 1.33%-ish, right? And today's year-over-year hourly earnings is at 4.4%. In order to look at real inflation, you get about 3% inflation, which seems to be in line with the headline CPI number, but it's certainly lower than the core. right? So I'm not sure that we can say that wages are going to be fueling inflation. But the reason why I think yields may have overdone it today is because the Fed is stuck on that 2% inflation target. Whether or not 2% is the right number is a different kind of a debate. But as long as they're stuck on that number, the inflationary figures as well as the wage growth figures, it's not going to be good enough for them. So we may still be looking at either a September rate hike or another rate hike before the end of the year.
All right, Anna, I have a few things to say, one being excellent jacket choice color, first of all. Second of all, I really take your point on the 2% inflation target. I feel like I've been asking that question for a while now. At what point will the Fed have to abandon it, even if it doesn't say it out loud? But if we're operating under the assumption that they still do want to get to that target, and to your point, that may mean a move in September, that rates may have to go higher, stay there for longer. How does that on the rate side then feed into the equity side, considering we are seeing the multiples that we are at the same time that we are still talking about much higher borrowing costs?
Yes, so one of the things is that the rate hikes really have not made their way all the way through the main street, right? So one of the things that we that you can look at is what we experience every day, which is in the residential real estate market. The fact that there's a dearth of homes for sale because people want to sit on their historically low mortgage rates tells you everything about how much people are rebelling against actually experiencing the rate hikes and how much the rate hikes actually have not made their way through Main Street economy. And a lot of these companies have borrowed when the rates were super low, and at some point they're going to have to roll over that debt. So all of this will have an impact on cash flow, future cash flow. And remember, inflation coming down also means that there's less pricing power for a lot of these companies. And also there's some news of worker hoarding because it is so difficult to find skilled workers. If you're keeping workers on payroll, even though they cannot fill a full work week, like we saw today, the work week dropping, then all of these things are pressure for margins. And so the spectacular year-to-date run-up we've had in the equity markets, we may be in for a completely different type of an environment in the second half of the year.
So you'd be a seller of stocks right now?
I don't know about seller of stocks because, again, I don't want to bet my farm on just one thing. But I think it would be very prudent to be rebalancing and taking some of those gains off of the table.
Are we talking about tech here, Anna, considering the mixed results we got from Apple and Amazon overnight? And Apple clearly is getting punished for it to a certain degree this morning, but it also is one of those stocks that had run up incredibly far so far this year.
Yeah, so I think tech is, there are two different things here. There's earnings, which is the fundamentals, and Apple really is selling products, right? And these goods are going to feel some pressure because of the inflationary pressures, and there's no running away from it. There's no hiding it, right? But then there's also the run-up because of the AI component. AI is a real thing. It's not happening today. It's not happening tomorrow. It is coming down the line. And you do see companies talking about putting some investments into AI. So I think the hype, which is essentially the essence of growth stocks, the valuations may be justified somewhat over the AI excitement, but certainly on a fundamental level, there's definitely headwind.
Do you not need to see in the near term, Anna, some sort of catch-up? Multiples have expanded really rapidly. Earnings haven't. And I appreciate that there is the AI kind of narrative that needs to be folded into this. But at some point, doesn't that gap between multiples and earnings need to close one way or the other?
Yes, I mean, it is a little scary to see the third quarter of year-over-year earnings decline in the S&P 500 and also see it soar in terms of price. And this is purely a multiple expansion. History tells us that this will catch up with us, if anything, temporarily, right? Even if AI is something to be excited about, it's not going to be a reality in terms of productivity for the next year or two. So this is something that is definitely further along the line. And in the meantime, we're probably due for some level of volatility.
All right, Anna Rathbun of CBIZ Investment Advisory Services, thank you so much for joining us on this Friday, and have a great weekend. Now, coming up, whether you're traveling for the weekend or traveling in general, demand is looking pretty strong for Booking Holdings. We're going to speak to its president, Glenn Fogel, next. This is is Bloomberg. Well, booking shares are up 8.7% at this point in the session after reporting second quarter results that beat estimates. The owner of brands like Kayak, Priceline, and OpenTable pointed to strong demand trends. Joining us now is President and CEO of Booking, Glenn Fogel. So, Glenn, obviously things are looking pretty good right now in terms of travel demand. I just wonder how long you expect it to last.
Well, thanks for having me. And of course, one never knows what's going to happen in the future. We've experienced that over the last few years for sure. But one thing I do know that in the long run, people are always going to want to travel. And you can basically make a guesstimate that travel is going to increase faster than GDP. So in the long run, we're going to have more travel over the long run. That's going to help businesses that are in travel like us. And our job is to make sure that we are participating and gaining share, producing better services, better ways that we can help the traveler so they'll come to us versus our competitors. That's the job.
I want to come back and talk about that in just a moment, particularly the AI thing that you're doing, Glenn. Good morning, it's Guy. Can we just talk a little bit about what's happening in the here and now, though? Right now, the picture seems to be, particularly in the United States, that we are seeing a boom in international travel. But then I look at the numbers that Robin Hayes and others are reporting for U.S. airlines, JetBlue talking about it, others talking about it as well. They're having to cut prices because domestic demand is not as strong as was anticipated. Is that the picture right now? Booming international, but domestic slowing. And does domestic then ultimately bleed into international? That slows as well. Can you just talk me through how you think the next 6 to 12 months are going to evolve?
Yeah, and one always has to be very careful about what you're comparing to. So certainly some of the domestic airlines in the U.S. have indicated that they're having less business than they did in the past because they are saying that Americans are traveling abroad now. And that is absolutely correct. But look where they came from. A year ago, second quarter numbers were just fantastic for everybody because so many people in the U.S. were traveling and it's primarily domestic. So it has to be a comparison. Now, you do point out the correct thing. The way we look at the world, and we're very global, we look and we say, well, Asia, fantastic second quarter for us, up 40% year over year. But if you recall, Asia was a little slow coming out of COVID. So we're comping against an easy comp, whereas in the U.S., we're comping against a harder comp. Long term, I'm not going to concern myself too much. Obviously, a lot of bumpy things right now. I know in a year or two, things will normalize and we'll get back to what I said originally.
Well, Glenn, when we talk about the demand rebound after the pandemic, it seems that people were just completely insensitive to price because everybody had all these built up savings from staying at home for so long. They hadn't traveled in a while. They were willing to pay up in order to do so. Are you seeing price sensitivity, though, starting to come back in?
No, we're really not. Talked about it last night on the earnings call, where ADRs for us, that's the average daily rate at a hotel, globally, it's up. Now, there are always going to be some areas where there's some variation. Some things are going to go down a little bit because a year ago, demand for that particular local area was just out of control. So prices were very high. And now as people are able to travel to other areas, there's less demand. So prices could drop in those very local areas. But we look at things on a very broad basis, and we're looking globally. Yeah. ADRs are up.
Glenn, do you think the market should rate you as an AI company?
Well, I'm not sure how people should decide how much weight should you give for AI. AI is extremely important to us. It has been for over a dozen years. You know, a lot of people are all excited about generative AI, which came out first in the fall, but we've been dealing with things with machine learning for over a dozen years. That drives our company. We have a tremendous number of people, AI experts, data analysts. That's how this business is run. We are an AI first type company and have been for a long time. Now we've come out with the new Gen AI product. We have one thing for our Booking.com company, which we call our AI Trip Planner. It's at the top of the funnel. People can use it to plan their travel. We have another thing at the bottom of the funnel, which comes out from our Priceline brand. It's called the Penny. It will help answer questions a traveler may have about a particular product, a particular hotel they're staying at. And then we have our ChatGPT plugins for OpenTable and from Kayak. And the last thing is, at Agoda, we're working how to use AI to be more efficient internally using different types of co-pilots to help make your coding more efficient. All different areas. We got a lot of emphasis on that. And I really think over several years, this will really be a game changer.
Glenn, can I ask you about another potential game changer, and that is the weather? We are seeing extreme weather in parts of Europe this year. Many people are being put off traveling to certain areas. We've seen the evacuations from places like Corfu and more notably Rhodes. Talk to me about how you think this will impact long-term travel. Are you already starting to see potentially an impact on long-term travel? Are people going to be going to the mountains? Are they going to be traveling in the spring? How does this change? How does this shift in the weather pattern start to change the travel business?
Well, I think it will over time, but it's going to be one of those slow changing things. People have historically thought, well, I'm going to do my travel in the summer, that being the northern hemisphere summer, and people think I'm going to go to the places that I want to see, not recognizing those places may be very, very warm or even dangerous, as you pointed out, what's going on in Corfu and Rhodes. Very, very tragic about those things. So I think there will be change, but it's going to take some time. But we see reports that say certain areas that are cooler right now, like Scandinavia, or even the place where you're from, Wales, there's going to be more travel to those types of places. Yep. But it's going to take some time. Our job is, again, making sure that there's availability and great prices no matter where somebody wants to travel to.
Yeah, not from Wales, but remember going on holiday to Wales as a child to my grandparents' caravan. The sound of rain on that roof will stick with me forever. So the weather probably needs to improve quite a lot. Glenn, great to see you. Fantastic numbers. Congratulations on the market reaction that we're seeing today. Glenn Fogel, Booking Holdings CEO. Coming up, cracks in the bond market. Wall Street piled into cheap debt created by the banking crisis. We're going to look at the fallout in today's Wall Street beat. That's next. This is Bloomberg.
Time now for Wall Street Beat, where we look at what is buzzing on Wall Street and the world of banking and finance. And we want to talk about the bond market. It's been feeling the pains of uncertainty this week, and Bloomberg's Sonali Basak has been looking at the cracks that have started to show up. Sonali, of course, this week brought a lot of surprises for many of us, including the Fitch downgrade of the U.S. credit rating, but they also downgraded Fannie and Freddie, and I feel like none of us paid that much attention to that.
Yeah, and it's worth paying attention to now for a couple of reasons. You see these long-dated maturities when you look at Treasury markets blowing out pretty significantly. But when you look also at the mortgage market, it is pretty interesting. Remember, this market, agency-backed mortgages, are a place where PIMCO, TCW, Soros Fund Management even went to Bloomberg Invest and said it was one of the best trades this year, really facing a lot of pressures, first during the banking crisis, and now you have Fannie and Freddie also facing a downgrade, and you're seeing those strains start to hit the mortgage market as well for agency mortgages. This is interesting for a couple reasons, not only because of the big liquid bond fund managers plowing into this trade that has faced some significant movements in the last couple of months, pressures even. You also have private credit giants, guys, moving into non-agency mortgages. That has been a move that you've seen for the last several years. Yep. Think Apollo Athene, but I think it poses a very interesting question now on the risk reward you're getting for non-agency versus agency mortgages.
How big an effect could there be? Everybody's dismissed this as a non-event, Sonali.
Well, you know, it's interesting. It's a slow bleeding one, isn't it? Because first you're seeing the movement in the 30-year. The other place I was looking was at high yield spreads, which have widened out a little bit this week on the heels of all of this, but not meaningfully. And when you talk to folks about this, there's a long-term tightening of financial conditions embedded in what's happening here. And Guy, if you look at the next couple of months, it actually kind of gets a little bit scarier because you have October, you have the budget discussions. When we spoke earlier this week to Signal Global, they thought this would be another kind of catalyst here, particularly to the Treasury market when you're thinking about the government infighting and what it means for the bond market. The ripple effects are really what we're looking at here. Mortgages is just one hot spot on Wall Street. When you look at high yields as well, I think I wonder over there how much left there is to crack, given we haven't seen maturity walls really being hit in a meaningful way yet. So what's the trade? I think that is still something I've asked a bunch of bond fund managers today, how they play this. I think it's still unclear because I think it's going to take a while to shake out rather than sharp movements here.
Okay, so Shonali, that's in bond land. In equity land, I have my eye on one stock in particular this morning. Icon Enterprises down 27%. They cut their quarterly payout in half. Is this just a blame Hindenburg situation?
Something interesting about this here is kind of the mea culpa you see from Carl Icahn, this letter to shareholders that he put out. This idea that they want to go focus more heavily on activism. The stock price is responding here to the dividend cut. And really, that is one of the short sellers' central claims here, that dividend was unsustainable. So you did have this dividend cut, plus a very big move here to the return of Icon's central competency, which is activism. And he had really gotten into a lot of other areas, and we can see him kind of going back to his roots now.
Back to your roots. Shonali, thank you very much indeed. What a fantastic week of coverage from Shonali Basak. It's going to be interesting to see Carl Icahn do that and how successful he will be post all of this. Shonali Basak, thank you very much. Indeed, great stuff. Let's talk about where we are with the markets right now. Europe is kind of coming to the end of a week. It's been a painful week for European equities. We're up by 0.3%, but on the week, the stock 600 is down by 2.5%. This is where we are right now, just sub 460. We were kind of up at 470. There's some key technical levels around this point, which is really worth watching out for. Solid German factory data out a little bit earlier on. Pay attention to that. Was it an anomaly? We are now seeing a bid back into the German 10-year. I think that's being driven largely by what is happening out of the US and the reaction to what we're seeing with the payroll number. And AP Müller-Merz, this is an interesting story. This was the kind of the darling during the pandemic. Freight rates went sharply higher. Now they've come down. They're having to react as a result of that. What is interesting coming out of AP Müller-Merz, though, is that they see slower growth but not a recession. And I think that's kind of telling. That seems to be kind of where most people are at the moment. And the fact that one of the world's biggest shippers is saying that, I think is really instructive. 4.81% is, though, the stock drop that we are seeing today. Coming up in the next hour, Barney Boasia, UBS's chief strategist, is going to be joining us. Looking forward to that chat. This is Bloomberg. Friday, the 4th of August, European stocks up on the day, but definitely down on the week. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
Whip you through the price action. Stock 600 up by 0.3%, but down 2.5% on the week. It has been a tough week for European equities, with a number of strategists turning negative on the European space. Credit Agricole out with some really solid numbers today. The numbers in the bank itself look pretty good. They're also making a further move into wealth management. The market likes it. The stock up by 6.8%. DraftKings numbers really strong, feeding through into Europe really quite nicely. Entain, one of its competitors, benefiting from that. That stock up by 1.4%, Kaylee.
All right, well, we got some big stock movers here in the U.S., Guy. Two tech giants moving in two very different directions. Amazon, the big leader today, up about 11% at this point in the session. You had a strong revenue figure. AWS, the cash cow, doing really well. Plus, Andy Jassy is successfully slowing the pace of spending. So all of that adding up to a really good day for that stock. But it's not a great day for Apple. It is down about 3% after another quarterly revenue decline, the third in a row. The iPhone, a point of weakness. The outlook not really fostering confidence either. And so that stock is feeling the pressure, but remember, it had run up substantially into the print. It was up about 48% year to date before yesterday, I believe. Then the other story is in the bond market, because of course it's jobs day here in the U.S. You did have a downside surprise on payrolls, but unemployment rate at 3.5% and wage growth was hotter than expected. What that all adds up to today is downward pressure on Treasury yields. The 10-year yield down about 7 basis points. We're at 4.10, but remember, 2 weeks ago we were at 3.83, so we still are up much higher than we were, and the 2-year yield down about 6 basis points at 4.82, Guy.
Kaylee, I want to carry on that conversation about what's happening with the wage narrative. Clearly, the payroll number contains some interesting data on that. Take a look at what is happening with the Teamsters. Take a look at what is happening with the UAW story as well. Unions are flexing their muscles. They want significantly more money. Today, the Unite union in the UK got it. Around 24,000 British Airways employees, remember British Airways, owned by IAG. They're going to be getting a pay rise of just over, I think it's 13.1% over an 18-month period, Kaylee. And that just speaks to the fact that particularly at the lower end of the wage spectrum, you are seeing some really big pickups in wage settlements. And you do wonder whether ultimately this becomes stickier and stickier and stickier. Certainly that is a concern here in the UK. The Bank of England was talking about how some of that is certainly beginning to crystallize.
All right, Guy, I don't know if you can hear the fact that they're drilling in the studio or above my head right now, but we do want to listen to something else that isn't the sound of drilling noises, because earlier today, Bloomberg caught up with the acting labor secretary, Julie Su, who was talking about what we're seeing in both wages and employment here in the U.S. Here's what she had to say.
This is steady, stable growth. It's what we would want in the economy, right? We had record levels of recovery from the global pandemic and its ensuing economic catastrophe. And now we are seeing what steady, stable growth looks like. 187,000 jobs created, bringing the total since President Biden came into office to 13.4 million, at the same time that we continue to see record low unemployment rates.
Takes us to our question of the day, which basically relates around what is happening with the wage story and whether or not that's going to lead to higher yields. Austin Goolsbee pulling a little bit of cold water on this, but here's our question. If wages keep growing, will yields keep going? It has been a huge week for the bond market. Such turbulence, a number of factors coming together. But the wage story is really interesting. Is it a lagging indicator? At some point, maybe it isn't. That's when you get into the wage price spiral, and that's the concern certainly here in the UK. Let's debate this now. Bloomberg's MLive Simon White, Liz McCormick joining us to kick things around. Simon, it's been a huge week for the bond market. So let's just start there and try and understand what is happening here. I've heard all kinds of different theories this week as to why we've seen this big spike higher in yields. Some are saying it's about issuance from the government, and certainly there's an element of that. BOJ is another factor. Maybe the downgrade, maybe that's a little bit questionable. And then you come to the macro data and you look at the wage story. Maybe that's something else you could fold into it. Is the wage story, though, a reason to think that we're going to continue to see inflation going higher? I've been talking to you all week about this whole idea that the bond market's beginning to sniff out higher inflation. What role do wages play in that?
So I think people are kind of coloured by the previous episode. So the 70s is the sort of go-to episode of high inflation. And back then, definitely the vector or the main vector of inflation was wages. So you actually had a reasonably positive correlation between yields and wages back then. But since then, it's basically been on average zero. And I think this time round, it will not be the same. You don't have, you mentioned some of the union stuff there, but you just don't have the same level of unionization.
Yep.
So you are going to see, for sure, some feed through, but you've got other aspects here. We've been running this in the US anyway, and in other countries, huge fiscal deficits outside of recessions, that have lingered on after the pandemic. And that's been a huge boost for corporate profits, right? The more that one sector is saving, is spending essentially,
yep,
the other sectors benefit from that. So that's really been a big part of corporates' pricing power and margins that we've seen. And that's been feeding into inflation. So I think that is probably even, so far that's been more influential than wages. So I think going forward it's going to be a combination of different things. I just don't think wages are going to play quite the same role as they did as in the 1970s.
Okay, so Liz, if it isn't wages per se, but just broader reads on inflation, which is what the Fed is trying to do, is get whatever those reads are down to target. They're looking for 2%. I just wonder if the bond market action we have seen maybe today aside is a reflection that fight for the Fed is going to be harder than we all maybe had been complacent thinking about in recent weeks.
Yeah, so I agree with Simon. It's less a wage thing, and I think actually, what happened in the bond markets this week was the mix of things like I laid out, and I don't think it was the markets getting ginned up on inflation worry, because you didn't see inflation expectations rise. We've really seen real rates go much higher, so it's really been a real rates driven thing, which that means it's about the outlook for the economy. Remember, the soft landing got a little ginned up more this week with some of the data, and the supply coming is bad for nominal rates typically. And then, the outlook for, what happens with the Fed. So I really don't think it's been people afraid of wages. And like we said, Goolsbee, a known dove, he kind of tamped that down today. We did have rates fall a little today, even though the wages were strong. So I think the bond market, and, we've seen a lot of curve steepening, so it's more like people buying, maybe the Fed can be on hold, and that there's these other forces, more term premium, BOJ letting an anchor go on long rates that is going to kind of drift the curve to a continued steeper stance.
Simon, Liz says this isn't about inflation. Liz says this, you can see that because of what is happening with real rates, that it's a bunch of other factors. It's a supply side story, it's the BOJ. What do you say to that?
I mean, inflation is always going to be the lingering in the background. I mean, what we've seen this week, so we have the eyes were on, as you said, the Fitch thing itself probably wasn't a big deal, but it refocused on the massive fiscal profligacy that we've seen in the US.
Yep.
And that obviously then related, they're having to borrow so much. If they haven't to spend so much, that means they're going to have to borrow so much. And we saw that in the refunding announcement.
Huge.
It's huge. And the net impact, if you have governments running persistently large fiscal deficits, inflation is a byproduct of that. So whether it's like, are they looking at inflation right now? Maybe, maybe not. CPI has come down to 3%, but it's like a symptom of the reasons, right? So that it's impossible for the market to swallow that huge supply without extracting some extra premium, because that has, liquidity implications. If you look at demand, foreigners have been jettisoning US debt. They're $5 trillion less since 2021. That's 10% of the total. US banks have been jettisoning US treasuries and agency debt. And the only sector that's adding to its treasury positions is the household sector. So they're taking on that duration risk. And obviously the Fed is running down its portfolio as well.
Right.
So this has liquidity implications, right? So therefore it makes sense for the market to try and extract extra premium to take account of that extra risk.
Liz, is this another case of us thinking so much about the Fed's rate hikes and not enough about the Fed's quantitative tightening, about QT and its impacts? Have we really started to see the full effects of that borne out yet?
Yeah, I mean, I'm a bit of a bond nerd, so I can never not think about the Fed's QT, but I think that's a good point because people are saying, hey, QT is going on as well, right? And the Fed, Chairman Powell in his recent press conference and some others speak made it seem like, oh, even there's possible, which people never thought, when the Fed starts cutting rates, QT could continue on. So you have that lever, which is, again, puts a bias towards a steeper curve because that weighs more heavily on the long end. So, yeah, QT is churning along, and it's now at full force. So I think you're right. That's another thing we maybe should not forget to talk about, that is ongoing, that is tightening. And, again, even if things start to go better, Fed says kind of we're done for now, that's still plowing along.
All right, note to self, ask more questions about QT. Bloomberg's Liz McCormick and Bloomberg MLive's Simon White. Thank you both so much for joining us. Now, coming up, we're going to talk more about our question of the day. If wages keep growing, will yields keep going? Banu Bueja, UBS chief strategist, joins next with his answer. This is Bloomberg.